Ross Stores has beat the market, returning over 12% to shareholders in the last year, but can they keep this up? We're analyzing Ross Stores Inc., stock ticker ROST, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Ross. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Ross Stores for your portfolio. Before we get into these valuable metrics, let's understand Ross Stores stock performance. Right now, Ross Stores trades for $103.79 per share. In the last year, their stock price is up 11.5%. Ross also pays a 1.2% dividend yield, which is in addition to these returns. In their last 5 years, the company's compounding at 5% annually. In the last 10 years, Ross is doing quite well. They're compounding at 12.5% annually. Going back prior to the global financial crisis, over the last 18 years, Ross Stores compounds at about 16% annually. This beats the market over these last 2 decades, outperforming most businesses. Their average dividend yield is in addition to these returns. Ross currently trades $19 below their 52-week high. The company is up $30 from their 52-week low. A little under 2% of their shares are sold short. Ross is a big business. They have a $35 billion market cap. But the burning question is, what could have led to this outperformance? Ross is a leading American off-price apparel and home fashion retailer, operating over 2,000 stores under the Ross Dress for Less and DD's discount banners. Ross offers a variety of name brand products and targets undercutting conventional retailers' regular prices by 20 to 70%. The company uses an opportunistic, flexible merchandising approach together with a relatively low-frills shopping environment centered on a treasure hunt experience. Ross maximizes inventory turnover and traffic, enabling its low-cost approach. In fiscal 2022, 26% of sales came from home accents, including bed and bath, 24% from the ladies department, 15% from menswear, 14% from accessories, 12% from shoes, and 9% from children's. All sales were made in the United States. Starting with metric number 1, we want Ross's average return on capital in their last 5 years to be above 14%. There are 2 key reasons for this. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. These business returns are captured here by return on capital. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in margin of safety based off the quality of the business. Ross's returns on capital have been all over the place in the last 5 years. Their returns cratered in their fiscal 2021, which incorporated most of calendar year 2020 as the company was dealing with rolling global lockdowns. Their returns on capital, which were quite strong prior to 2020, have rebounded since. They earned about 19.5% returns on capital in their most recent fiscal year. Averaged out over this time, Ross earns about 26.5% average returns on capital in a given year. This is nearly 4 times better than that of a typical business. This is a big check coming in on metric number 1 for Ross. Metric number 2, we're looking at growth. We want 5-year growth in their revenues, net incomes, and free cash flows. This metric's all or nothing. All 3 of these have to be up for this to be a check. During this time, Ross grew its revenues by 25%. We can see the company dipped in their fiscal 2021 as again they were dealing with those lockdowns, but they've recovered and grown over this period overall. The company's earnings are down slightly. They're down just 5%. Ross's free cash flows have taken the biggest beating here. They're down 38%. Looking at their cash flow statement, we can see that's primarily due to changes in their accounts payable, changes in their other net operating assets, and an increase in CapEx over this time. Because of those 3 factors, their free cash flows are down. The company only saw revenue growth during this time, meaning this is an X on metric number 2 for Ross. Metric number 3, we're taking the perspective of an individual shareholder by looking for earnings per share growth in the last 5 years for Ross. We learned the company's earnings declined by 5% over this time, so you would think that their earnings per share would be down. However, Ross has bought back 7% of their shares outstanding, reducing their share count. These share buybacks are outpacing their declines in their earnings, meaning their earnings per share are actually up over this time. This is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. Their free cash flows also declined during this time. These declines were pretty steep compared to the declines in their earnings. Unfortunately, their share buybacks are not outpacing their declines in their free cash flows. Ross's free cash flow per share is down over this time. This is an X on metric number 4. Recapping where we stand currently, through our first 4 metrics, we're split evenly. We have 2 checks and 2 X's for ROST stores. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. In metric number 5, we want Ross's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow the company has produced in their last 5 years. Currently, Ross has about $1.1 billion worth of net debt. In all 5 of these years, the company has been free cash flow positive. During this time, Ross produced $7.3 billion worth of free cash flow. They're easily able to support their net debt position. This is a big check on metric number 5. Ross looks to be strongly cash flow generative relative to their debt. They'd be able to pay off their net debt with just over 1 year's worth of their current free cash flows. This is our 3rd check of the day. Before we go on to metric number 6, it's time for our bonus. As our bonus, we're looking at Ross's dividend profile. Ross currently pays a 1.2% dividend yield. We're looking to see if this is sustained by their cash flows or not. In all 5 of these years, even though their free cash flows are down over this time, Ross has supported their dividends pretty easily using just those free cash flows. Ross did cut their dividend pretty dramatically in their fiscal 2021. Since then, they've increased this. It looks like the company's dividends are pretty much right back on track to where they were prior to 2020. Because their free cash flows per share have declined over this time, the company now has a higher dividend payout ratio than they have in the past. Keep in mind, this is a snapshot of their last 5 years of performance, and it's no guarantee for the future. Ross's dividend seems healthy, and it's well supported by their cash flows right now. The big metric of them all, metric number 6, we want Ross's average 5-year free cash flows to their total enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It may offer a reasonable starting point for a valuation of Ross. Right now, Ross has a $36 billion total enterprise value. This takes into account their market cap and their net debt position, offering a perspective of Ross similar to as if it was a private business. In the last 5 years, we learned Ross produced $7.3 billion worth of free cash flow, meaning in an average year, they produce about $1.5 billion worth of free cash flow. When that's divided by their $36 billion enterprise value, that gives about a 4% average free cash flow to enterprise value yield. Currently, Ross produced $1 billion worth of free cash flow in their last fiscal year. When that's divided by their enterprise value, we get about a 2.7% current free cash flow to enterprise value yield. These yields are split on either side of the yield of the 10-year treasury. However, they're both down from the risk premium we'd be seeking, meaning this is an X on metric number 6. Don't just throw Ross out, however. There's still work to be done as we come to a more concrete estimate for their fair intrinsic value before giving our final rating to the business. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Ross, which takes us on to using a discounted cash flow model to come to an estimate of a fair stock price for Ross. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with a 3-year average of Ross's free cash flows, then using historical assumptions to grow these into the future. It's up to you to do the work to figure out if these are going to be accurate for the business going forward. Assuming Ross grows their 3-year average free cash flows at just under 11% annually for the next decade, then in the 10 years from there, that this growth rate would be cut in half, and the company would be growing these free cash flows by just under 6% annually. If we add in the company's tangible book value, which gives us an estimate of their net worth, you should note that this may be skewed based off how the accounting is done for the company's share buybacks. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for from his investments, in addition to his margin of safety requirements, at today's valuations, it looks like an estimate of a fair value for Ross is around $61.50 per share. That's down more than $40 from the company's current stock price. There are key points to be mindful of. Ross has had a low degree of business predictability, especially as lockdowns upended and disrupted the business in 2020. The company could also have this same degree of low business predictability into the future. This 15% discount rate is an estimate of total returns to shareholders. It would already be including the company's 1.2% dividend yield. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any investment decision, consult with your financial advisor. In just a minute, we'll talk about our final rating for Ross, but we have to address something first. We focused a lot on the numbers, but what are the qualitative aspects of the business? Starting with the qualitative aspects supporting a potential long thesis for ROST. Number 1, other physical retailers downsizing should lead to an ample supply of attractively located, well-priced storefronts that should fuel ROST's expansion. Number 2, its treasure hunt shopping experience, agile supply chain and distribution network, and merchandising strength maximize ROST's flexibility while holding inventory levels in check, minimizing risk while freeing capital. Number 3, ROST should be relatively well insulated against digital rivals considering its differentiated store experience and operating efficiency, which fuels its low prices. Then the qualitative aspects supporting a potential short thesis. Number 1, rising labor costs constrain margins with asymmetric pressure relative to online rivals, considering ROST's need to maintain in-store staff. Number 2, digital sellers are building distribution leverage, easing returns and pricing aggressively, necessitating continued cost containment to fuel low prices while maintaining margins. Number 3, economic turmoil continues to impact the sector, and while ROST's stores have performed relatively well, inflation and consumer demand shifts create volatility. There you have it for a balanced perspective of some of the qualitative aspects of ROST. Now it's time to give our rating. In analyzing ROST stores, stock ticker ROST, we learned the company earns average returns on capital nearly 4 times better than a typical business. In the last 5 years, they've grown their revenues and they bought back 7% of their shares. However, the company's free cash flows and their earnings are both down over this period. Even with those declines, the company easily supports their net debt position. Their average and current free cash flow to enterprise value yields were split on either side of the yield of the 10-year treasury, but both down from the risk premium we'd be seeking. While their free cash flows have declined in the last 5 years, ROST has easily supported their dividends throughout this time, and their dividend has grown. It's worth reiterating this analysis is not financial advice. When we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, from today's valuations, if you are seeking a 15% rate of return, an estimate of a fair intrinsic value for ROST is around $61 per share. The last time the business was at those levels was September of 2017. That price is just $8 below the company's 52-week lows. Combining the factors of our analysis together, ROST looks like a moderate candidate for further research. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to look at next time. Thanks for learning about ROST with me, and have a great day.